Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, the U.S. and China reach a trade truce. President Trump and Xi Jinping met in South Korea. They agreed to a one-year trade truce. As part of that agreement, the U.S. will cut fentanyl-related tariffs in half and pause restrictions on blacklisted Chinese firms. China, in return, will restart soybean purchases and resume rare earth shipments, key wins for U.S. farmers and industry. The stock market reaction to the truce, relatively muted. Part of that is due to investors' focus on big tech earnings. Meta, Microsoft, and Alphabet, they all reported after the bell. Alphabet shares, the only ones that are jumping amid a surge in demand for its cloud and AI services. It's a sign its capex spending is paying off. But that isn't the case for Meta and Microsoft. Meta pledged to spend aggressively on AI next year, what the CFO said would be a notably larger amount than the $72 billion planned for 2025. But returns on those investments still aren't clear. Meanwhile, Microsoft CFO says they can't meet current demand for AI and other services, even after spending tens of billions in recent quarters, and they plan to keep on doing that. And investors are also closely watching the Fed. While the central bank delivered another quarter rate cut this year, Federal Reserve Chair Powell issued a warning.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
While Powell made it clear that the primary concern for some is a cooling job market, others inside the Fed are warning about persistent inflation. Further clouding the Fed's outlook, of course, the data blackout amid the U.S. government shutdown. Amidst these three big stories and themes this morning, let's get a check on stock futures. We are seeing a negative indication for the open here this morning. Now, even though the market might normally be greeting those trade headlines with more enthusiasm, maybe part of it was already priced in. Who knows? Maybe it's just that the AI trade is what it's all about right now, and the spending plans of those companies were not what the market wanted. And then, of course, you got the Federal Reserve as well, not guaranteeing another rate cut this year. All of that equaling indications for a lower open. The NASDAQ showing the biggest drop at the open. Futures down about 0.6%. Let's dig into our top stories of the day now. Investors process the latest results from big tech companies with capex in focus, plus President Trump's long-awaited meeting with President Xi Jinping in South Korea. Joining me now, Yahoo Finance executive editor Brian Sazi, tech editor Dan Howley, and Washington correspondent Ben Werschel for this big morning. Ben, let's start with you and what happened in South Korea.
Yeah, the agreement here between the U.S. and China, and the headline here is clearly these tariff changes. What Trump says he's agreed to is a 10% reduction on the fentanyl tariffs. That cuts them in half. It does leave the overall average U.S. tariff rate on Chinese goods at 47%. So still really significant tariffs there. But it is a move, if you're not a fan of tariffs, in the right direction, coming just days after Trump was talking about increasing tariffs. So he went from an increase to a decrease. Other elements of this deal, for at least what we know so far, is largely about maintaining the status quo. There's export controls are a major issue. China has agreed to pause its export controls on rare earth minerals in apparent concession as the U.S. talks about decreasing their export controls. Their 50% rule is what it's called on blocked persons. So there's a kind of a trade-off there. There's a mutual trade-off on shipping levies. Those are both going down. And then China is also agreeing to increase their soybean purchases. Treasury Secretary Scott Bessent said this morning the number there is 12 million metric tons, which by context is about 10% of the U.S. annual crop. So that's a significant resuming of purchases after China zeroed them out earlier this year. A lot of issues left on the table for future discussions, but the bottom line here for markets is that there is a truce that's going to keep going forward into next year while talks go forward and President Trump talks about visiting China itself next April.
Ben, thank you so much. Brian, let's talk a little bit about the implications of all of this. The market has been waiting for this to happen. It feels like what we've had with recent trade headlines is the negative potential is greater than the positive potential. In other words, when you get the president beating his chest again and raising tensions, stocks can fall. I mean, then you get stocks fall. When you get a positive headline, it hasn't always equaled a big upside.
Because at this point, look, I'm not going to sit here and say this trade news, or is it a breakthrough? Maybe it's a little bit of a breakthrough. It's not the main market driver. It remains, I think, a sideshow to the bigger story that has driven this market this year. And we're going to talk about it. It's AI. It's what's happening with big cap tech companies. How's the consumer doing in light of all these tariffs? And then secondarily, yes, tariffs will impact future earnings for companies, but these companies are still reporting that tariffs are having big impact. I was talking to Judy Marks, the CEO of Otis, yesterday. Of course, they make elevators. Millions of dollars of steel-related tariffs are impacting her business. So it's not like this issue is going away overnight.
Right.
We're still going to hear about it. It's still going to bring headline risk to market. I just think it's a sideshow.
Well, and those specific sectoral tariffs that are affecting the likes of Otis are still in place, right? And there's still a court case that's going to be decided to see if those remain in place.
The tariffs are still in place.
Yes,
let's just be clear. It might be getting lowered down a bit, and that's all good, man. But look, these things are still in place. They're not going away. If they went away, Julie, then the markets probably take it more seriously. Yeah,
and just quickly, in terms of where we might be seeing this felt in the markets, as we look around here this morning, we had been seeing, some movement in some of the U.S. listed China companies. Many of them have been trading lower, the likes of Alibaba and JD, the big Chinese internet companies that we kind of view as maybe something of a proxy.
Which is interesting. It's weird to me.
Well,
that move's strange.
Here's another strange move. The rare earth companies that are based here in the U.S., most of them are just in the exploratory phase, they're trading higher, even though China is going to be resuming their rare earth exports. So that's a little confusing as well. Maybe the thinking is that the projects and the investment on the part of the U.S. is not going to stop or slow down.
And this sector is no longer under or being weaponized, whatever it is. Also the retail. Also some of the retailers, those based in China, Nike, Under Armour, that have relied on China for eons. Again, this is not mind-blowingly positive news, but incremental at this point. Maybe their next 12 to 18 months won't be as brutal as the past 12. Yeah,
okay. We got to get to the other big story that we're watching this morning, and that has to do with those tech earnings. Dan Halley with us for that part of the story. So, Dan, the spending really is the thing that seems to be grabbing all of the headlines.
Yeah, we might as well just, call it quits right now because that's it. It's all about how much they're raising capex, specifically Meta. They raised their bottom line for the capex, the bottom end for their capex, from 66 billion to 70 billion. So it's between 70 and 72 billion. The high end was still 72, but obviously it's that lower end number that people are kind of freaking out about. That's for spending on CPUs, GPUs, data centers, all of that. Clearly, investors not excited. I think last I saw in pre-market, they were off as much as 10%. Look at Microsoft. Kind of the same deal. They're going to continue to spend. But by the way, Meta, just in case investors weren't wary or weary of the spending in 2025, they said they're going to significantly increase it next year. So just, buckle up for that. I don't know how many data centers you can see around the country, but apparently a lot more. Microsoft, meanwhile, they're also going to be raising their capex. They didn't give us firm numbers, but they did say that it's going to be higher. And they say that it's going to be going to GPUs, CPUs, building out those data centers. And you mentioned it earlier, CFO Amy Hood saying, look, we're still capacity constrained, and we think we're still going to be capacity constrained through the end of the fiscal year. They're now in their second quarter of fiscal 2026. So they still have, a while to go before they feel as though they may no longer be capacity constrained. So they're still spending. I think the good news there at least shows that they're being judicious about their spending. Sure, they are pumping out, building out these data centers, but there's a demand behind it, right? So that means that they're trying to catch up to that. And one of the big numbers that we talk about, or they talk about, is performance guarantees that are still outstanding. And so that's basically, contracts that have been signed but not paid for yet, things along those lines. And they still have a large amount of that. I think it was 400 million in the prior quarter. And then, when you look at Google on the flip side, things appear to be hunky-dory for them. They're still going to be raising capex, still building out, but the results seem to be doing better than, well, at least as far as investors go, than the others, just because of the Google Cloud Platform performing so well. And so, it's this continued fear of, okay, you keep pumping billions into this. Where does this all go? And I think for Microsoft and Google, it's pretty clear it's going to their cloud. Microsoft, they have the whole OpenAI deal. They no longer are the cloud provider of choice. That might benefit Microsoft because, again, they're being very judicious about their build out. One of the questions that was raised on the Microsoft call in particular, and that Meta CEO Mark Zuckerberg had kind of hinted at in his own call, was about what happens if you don't make anything of this now. And it was kind of the answer from Zuckerberg, at least, was, look, we want to get the pain out of the way right away, and then we're not capacity constrained in the future. And hey, if people aren't using AI at that point, then we'll find something else to do with it. So, and then with Microsoft, it was, we have to build out. We just don't have the capacity, but we're going to take our time. And so I think that no longer being the sole cloud provider or even having the first right of refusal for OpenAI is a good thing for Microsoft in their head, because they don't want to be on the hook for all this capacity in this build out just in case.
Right. Dan, thank you so much. I just to emphasize what we're talking about, I actually want to play for people what the CFO of the company, Amy Hood, said on the call, because it really was pretty remarkable. So listen to what she said.
We are, and I said this now, we've been short now for many quarters. I thought we were going to catch up. We are not. Demand is increasing. It is not increasing in just one place. It is increasing across many places.
So this is remarkable to me, Brian Sozzi. Mm-hmm. They see this as non-negotiable. They do not have the capacity to meet the demand they are seeing.
Good signal.
And so they just got to keep spending and spending.
Before I dig in, I got to read this quote from Satya Nadella right after the earnings release yesterday, because I read it. I'm like, Satya, you're the man, dude, but I don't even know what the hell you're talking about. He said, quote, "Our planet-scale cloud and AI factory, together with co-pilots across high-value domains, is driving broad diffusion and real-world impact." Like, I don't even know what that means, man. All I know is that I hop on the earnings call, and I think Satya and Amy Hood silenced any concerns out there about the AI trade. We heard it from earlier with NVIDIA at GTC in DC. Strong demand signals. Jensen in his black leather jacket got on the stage and said, hey, we see $500 billion in demand for our next generation chips. Check, John, that is good. And Microsoft says, guys, we're going to double our data center infrastructure over the next several years. And they're going to build giant factories across this country. And I don't think Microsoft will be spending billions of dollars over the next 4, 5, 6 decade, whatever number of years, if they didn't see the demand there to support that. These are very smart people that know what they're doing, and they get paid a lot of money to do it.
Dan, get in there.
Yeah, just one thing I want to add is there was a question about what happens. You have a lot of the small players coming in and saying, look, we want to be a part of the Microsoft cloud. That's adding to the capacity constraints. Someone asked on the call, what happens if they don't have anything? What happens if they never pay you, or they can't pay you for those guarantees? And so the response there was, look, we're building out for the requirements that we have, for the requests we have for AI, and we're being careful about that build out. So I think the juxtaposition between what Mark Zuckerberg was saying and what Satya Nadella was saying was, the chasm there is extraordinary.
Listen, there's plenty of private credit out there to lend money to those companies to buy that capacity. I
got to drop this stat. I was very proud to pull it up, so I need to say it here, Julie. Microsoft, Google, or Alphabet, whatever you want to think of them today, Meta, $78 billion on capex in the third quarter. That's up 89%. Year over year. That is an absolutely mind-blowing number. It also makes me giggle a little bit because if 10 years ago we were having this conversation, nobody was looking at capex numbers for technology except Wall Street analysts. But now this is the biggest market driver here. These numbers you're seeing on the screen.
Okay, guys, we have to say one more thing, and that's about NVIDIA, which we haven't mentioned and wasn't mentioned apparently, or at least Blackwell was not mentioned in China. Obviously, that's the center of all this. NVIDIA is going to be benefiting from all that capex, as we know. But it's not necessarily going to be selling Blackwells into China. Like
I said at the top of the show, Julie, sideshow for now. What Jensen came out this week and mentioned at GTC, that $500 billion backlog for their newest chips, that is the stock driver. And it's great that Uber's now going to have autonomous cars in 2027 using NVIDIA chips. That number is what's going to drive this market. And now I suspect when you hear from Jensen again, when they report earnings, he will continue to update that number. And there's no reason to think it will not be even higher than $500 billion.
Yeah, that seems to be the indication coming from the analysts also. The stock's set to open below $5 trillion in its valuation.
Tough life.
All right. Brian, Dan, Ben, thank you guys so much. Appreciate it. Coming up on Morning Brief, don't forget about the other big element that we are watching. That's the Federal Reserve. Jay Powell dumping a little cold water on hopes for another rate cut this year. We'll be right back.
Hey, don't forget my show, 9:30.
Now time for some of today's trending tickers. We're watching Metsera, Merck, and Eli Lilly. First up, we got Metsera. The obesity drug company is now in the middle of a bidding war. Novo Nordisk has made an unsolicited bid for the company after Metsera had agreed to a deal with Pfizer last month. Novo offered to buy the company for $6.5 billion. Now Pfizer has just 4 days to make a better offer. The tussle follows setbacks for both Novo and Pfizer in an obesity market that's expected to reach $100 billion by 2030. Next is Merck, the drug maker trimming the top end of its sales forecast for the full year. While overall third quarter sales did beat estimates, it failed to produce any standout sales beats in the third quarter. Still, sales of Keytruda rose 10% from a year ago. But Merck is facing pressure as it prepares for the loss of its big cancer drug. Keytruda's patent expires at the end of 2027. The pharmaceutical giant is cutting costs in anticipation of that expiration. And finally, Eli Lilly beating estimates and boosting its full-year revenue guidance. Results were boosted by its blockbuster weight loss and diabetes drugs that beat expectations in the third quarter. Diabetes drug Mounjaro and obesity treatment Zepbound outpaced expectations by a combined nearly $1.3 billion. The shares up 3.5%. And stay with Yahoo Finance because at 11:30 a.m. Eastern, I'll be sitting down with the CFO of Eli Lilly to talk more about the results. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the Federal Reserve cut interest rates by 1/4 point for a second consecutive meeting, but Fed Chair Powell is taking a hawkish stance on further cuts this year.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
Joining me now, Leslie Falconio, UBS Global Wealth Management Head of Taxable Fixed Income Strategy, and John Hilsenrath, StoneX Senior Advisor and Yahoo Finance contributor. Leslie, let's start with you. It seems like the market was caught a little bit off guard by Powell's comments, even though the folks we've been talking to in the past few weeks have said, no data, no cut.
Yeah, there's no question. I mean, I would say caught very off guard. And when you think about what was priced in for the December cut, it was almost 100%. Prior to his, testimony. And as we know, when he said that December is not a foregone conclusion, that was in his written script. So I think the market really was not expecting to see that. They also weren't expecting to see, a descent on a dove and a descent on a hawk. Although they do anticipate this sort of disparity among Fed members, depending on which dual mandate you're focusing on. But obviously the market, yesterday we saw a decent, what we call bear flattener, that short end rate rose as they took the probability down to about 60% for the December cut. So I do think obviously the 25 basis point cut was priced in. The QT at ending of the balance sheet was a high probability, but his tone in terms of that hawkish remark and really stating that December is not a foregone conclusion, I think really caught the market off guard.
Yeah, John, why do you think it was such a shock for folks?
Well, first of all, I don't think the market should have been caught off guard because if you listen to what Powell said after the September press conference, again at an NABE speech, he pointed people in the markets to the Fed's own dot plot, which he said reflected the divisions at the Fed and the probabilities of another move in December, which pointed to around a 50-50 take for a December move, and the market was closer to 100%. So Powell said what he said yesterday because he thought the market was too locked into the idea that the Fed was sure to do another rate cut in December. So he was trying explicitly to correct market expectations. The other thing is Powell wasn't the only one before this meeting trying to pull the market back a little bit from this certainty. Governor Chris Waller, who might be the next Fed chair, also expressed his own caution about whether the Fed should move. There's a number of reasons why the Fed would have caution right now. I really liked Powell's fog comment, when you're driving in fog, the natural thing to do is to slow down because you don't know where the next turn of the road is going to come. So it makes sense for the Fed to slow down on this pace of rate cuts until it has a better sense of whether the economy is heating up or slowing down.
Leslie, it's interesting because you don't just think the market got it wrong for December. You think they have it wrong with the terminal rate, which had been pricing in at around 2.8%. So is that just a fog issue or a lack of data issue, or do you think it's a more fundamental issue that would lead them not to cut as much?
Yeah, I mean, there's two things. I mean, we lightened up on our interest rate risk during the September FOMC, and when we got around that 4%, and the fixed income market, as always, forward-looking, loves to speculate. In our opinion, it was just becoming a little bit too dovish, and it's not a question of whether or not that 3% is the terminal. It's really more the question of how quickly the market was pricing in that terminal to occur. And that really was the disparity that what we felt we were seeing and what the market was, pricing in a little bit too dovish versus what the Fed guidance was dictating. Now, to your point, I mean, look, we're going on data such as ADP. We're going on, things like CPI that we know is backward looking. We know OER is coming down after a very high number. But again, this is a lot of past data. So our view has been, yes, we do think the Fed cuts, but we don't believe that the Fed is cutting as quickly as the market was expecting. And although we do agree that the terminal might be at 3%, we just think the market was getting to that 3% much quicker than we were anticipating.
And John, what about the dynamic within the Fed, right? As we mentioned, we had a dissent on either side. Powell is a lame duck, for lack of a better term, at this point. How should we be thinking about that dynamic, especially going into next year?
Well, so I want to say two things. I want to say something about the dynamic within the Fed, but before that, I just want to echo these points about the terminal rate. What is the long-term rate where the Fed funds rate should be? I will say I think it's higher than 3%. I mean, I think I half agree with what Leslie said, but if you look at what's been going on over the last year, the Fed had a Fed funds rate at around 4%, and inflation rose, and financial conditions look awfully accommodative to me, with stock prices rising and spreads tightening. To me, when I look at what's going on in the markets and the economy, it suggests that a neutral rate is somewhere near 4% and not the 3% that the Fed has written into its models, which, by the way, are just models. In terms of the dynamics at the Fed, again, this gets to the market being too dovish, which is what Leslie was just talking about. I think the market says, okay, Jay Powell is a lame duck. The president is going to put somebody in there who wants and is going to get a much lower short-term interest rate. And that's what the market is going on. But my advice to people is watch Chris Waller. If Waller doesn't get the job as Fed chair, it's not at all clear to me that he's going to be on board with the president's view that we should have a very low interest rate, like closer to 1%. Waller didn't dissent with today's move. He's expressed caution about moving too quickly. And even if he doesn't become the chair, and he might not become the chair because he has too much of an independent streak, he's still a governor who could get in the way of these plans. I think the two dissents that you saw yesterday were indicative of where the Fed is going over the next year. There's going to be a lot of disagreement. There's going to be a lot of dissent. And it's not going to be an easy road, I don't think, for the president to get the very low interest rates that he demands.
Leslie, John, good stuff. Looking forward to continuing the conversation as we watch this over the next few months and year. That does it for Morning Brief. Much more ahead on Yahoo Finance. Saz has got you next on Opening Bid.